Hello and welcome to ThePrint. I'm Dr. Bidisha Bhattacharya, columnist with ThePrint, where I write on economics, public policy, macroeconomics, and much more. As India enters another crucial budget season amidst strong growth numbers, relative macro stability, rapidly shifting global landscape, there are a few economists better placed to help us separate comfort from complacency. And today I'm delighted to be joined by Mr. Neelkanth Mishra. Mr. Mishra is the chief economist at Axis Bank, head of global research and whole-time director at Axis Capital. He is consistently rated among India's top analysts in global investor polls and is widely respected for his insights on Indian and global macroeconomic trends. Before joining Axis in May 2023, he spent nearly 2 decades at Credit Suisse, where he served as co-head of Asia Pacific strategy and India strategist. Beyond markets, he plays a significant advisory role in public policy. He is a part-time member at the Prime Minister's Economic Advisory Council, chairman of UIDAI, and a member of TRAI, in addition to advising bodies such as the India Semiconductor Mission and the 15th and the 16th Finance Commissions. He has previously worked with HUL and Infosys. Dr. Mishra, thank you so much for joining us at ThePrint. We are really delighted to have you, and thank you for taking out the time to speak to us early morning today. I know despite your busy schedule.
Thank you, Bidisha. Thank you for having me.
So I'll just get to the question. The first question, I would like to focus on India's macro movement. Sort of beginning with the broad macro picture. So India kind of enters this budget season as the fastest growing large economy, with strong headline growth and sustained investor confidence. However, periods of comfort can sometimes try to mask emerging vulnerabilities. So from your perspective, what is that single biggest macroeconomic risk, according to you, that policymakers may be underestimating today? It can either be globally or it can be domestically.
No, I think the disturbance to global capital flows can be quite significant. People who were in the saddle, so to say, back in the late 80s, early 90s, actually worry about this, reminding them of the level of churn globally, reminding them of what happened between 1989 and 1992-93, when, if you recall, the USSR collapsed, there was the first Gulf War, there was the US recession, then the Mexican crisis. So there was a whole series of things that happened which actually completely disturbed global capital flows. The inflows dried up, and that creates significant problems, especially if you're a country like India, where you have a current account deficit. So the world is going through significant amount of churn. The US, which effectively acted as the global policeman, is now realizing that it cannot afford to be one. In 1945, when it was establishing the rules-based order, it was 56% of world GDP. It made sense for it to compromise, to actually establish rules which itself would follow. But today, it is realizing that following those rules, it can't really compete against China. So it is now withdrawing from the active role as a policeman. It is now still needs to fight the Chinese. So it is starting to use muscle explicitly in Venezuela, perhaps now in Iran. The Europeans have another issue. There is significant fiscal challenge in meeting their defense expenditure targets, which will mean that the Europeans, which were spending so much on social safety, will now have to cut back on some of those. On the third front, you have China, which has its own challenges. They're doing spectacularly well on technology, on production, but their local consumption remains very weak. They have, I think, meaningful risks on deflation. The damage from the real estate downturn is not yet fully shown in or fully factored in. And therefore, there are many changing patterns in the whole world. On top of that, of course, the US needs to devalue its currency at some point in the next 3 years. So it is going to be a very turbulent world. And I'm very happy that the Indian government, like the Honorable Prime Minister yesterday, announced that the reforms train will continue. I think the best way to handle and prepare for the storm is to actually make your ship stronger. And that's exactly what seems to be happening.
Interesting. I would like to stay with this external environment for a moment. Globally, signals remain quite fixed, and the US appears, headed for a soft landing. Europe continues to struggle a bit, and China's slowdown has started looking increasingly structural, if I would like to put it that way. Do you see this as a new, lower volatility kind of global equilibrium, or is this merely a pause, before renewed shocks? The shocks can be financial, geopolitical, or macroeconomic.
Look, the ability of a single person or a group of people to change how billions of people behave is always constrained. So, this whole political framing of the Leviathan and how it can affect people's lives and control people's lives, and what role can the state play in the very near term in the economy. I think the newspapers and the headlines and the posturing tends to exaggerate that. So in the near term, as you may have seen this year, the IMF expects 3.3% growth. If you look back for most of this century, we are now a quarter of the way through it. The mode, as you know, in statistics, there's mean, median, mode. Mode is the most frequently occurring growth rate. It is actually 3.5% over the last 25 years. So there was a period between 2003 and 8 where growth was much stronger. But beyond that, if you look at the 3-year CAGR, it kind of hovers around 3.5%. So 3.3% isn't that bad, given all the problems that we keep reading about in the press every day. I think it is a reflection of what I started with, which is that just because Trump thinks that he can impose tariffs and change trade flows are not going to change. You must have seen that despite the 50% tariffs, India's goods exports are fine. Despite the tariffs against China, Chinese exports are fine. Global trade to GDP, goods trade to GDP has actually picked up this year. I would say global services trade to GDP has also picked up this year, despite all the noise that you are seeing. So I think we have to sort of de-link the political churn, but you look at the violence that is happening within the US, all the churn that seems to be happening in politics within China, all the political disruption that is underway in Europe. And you realize that these are deep-rooted changes, but the economic impact of that could take a while. So the temptation for everyone is to look at headlines and start panicking and thinking that, oh my God, the world is changing. Well, the world is changing, but people who are used to trading in a certain way will continue to trade in the same way. If it means transshipment, meaning, say, a certain category which was being shipped to the US from China, if there is a very large duty, they sort of invoice it through some compliant country. And believe me, even the buyer on the US side would be very happy to accept that. So it is for the customs department in the US to capture that. So the world and businesses are far more resilient than what any strongman can pretend to do. And therefore, the impact of some of what we are seeing could be much longer term. The only two things that, therefore, we need to really worry about is, from the Indian perspective, is the price of energy and the availability of capital. So if both of these things are not disrupted, we should continue to focus on strengthening our own fort rather than worrying too much about global geopolitics.
Interesting, because you spoke about the Indian perspective. I would like to turn back to India, and the current growth narrative is often being framed around strong public capital expenditure and resilient domestic demand. So, in your assessment, how broad-based is this growth? Like, are we seeing the beginnings of a durable private investment cycle, or does momentum still continue to rely disproportionately on government spending?
I'm very uncomfortable with that framing. So you're right that that is the public framing right now. That is the consensus framing of growth right now. But I think there are many flaws in that framing. The first is that the quality of government expenditure has improved, especially the central government expenditure. But the government has been shrinking its fiscal deficit. So you would recall from macroeconomic theory that if the fiscal deficit is falling, the government is a drag on growth. It is not boosting growth. So, so from the first post-COVID year deficit of 6.9%, the government has very successfully consolidated to 4.4%. So 6.9 went to 6.4, then 5.6, then 4.8, then 4.4. So every single year, the government has been a drag on growth. So this whole narrative that the government is supporting growth is a violation of all theory and completely inappropriate. The first year impact of government spending is the same, more or less the same, whether you are giving a handout, the revdi, or you are building a road with it. It is only when the second and third year impact, so if you give the revdi, it gets consumed very quickly. If you build a road, it starts to have, it continues to have an economic impact for quite a while. There, I think the government has really hit the ball out of the park. So I think the discipline on building long-term assets, and remember that if you are trying to consolidate your debt to GDP from an extremely high level to a slightly more sustainable level, you need to be very prudent with the limited fiscal assets that you have. So if you consolidate too fast, you can get caught in a debt trap because nominal GDP growth will collapse. If you consolidate too slowly, the debt to GDP remains high. If there is another crisis, you can't really spend your way out of it. So I think the government has done the best possible outcome, but it is wrong to say that they have boosted growth. Why is India growing? I think India is growing because of plain simple Cobb-Douglas breakdown. We have a sharply growing workforce, so the workforce is expanding at 2% a year. There is now an expansion or an increase in the labor force participation rates as over the past decade, rural infrastructure has improved. Women are now joining the workforce. They have now the time to join the workforce. The classic Claudia Golden career and family, where for a long time it was career or family because you spent most of your time collecting firewood or fetching water or keeping the house clean, which was made of mud and bricks, mud and thatch. Now you have a pakka house, you have a toilet, you have dense energy, so you can cook faster. You have piped water, so there are 4-5 hours remain free that are free, and so all these women are now joining the workforce. So all of that is very helpful for growth. The state government and the central government are reforming labor laws. Just last year, 7 states allowed women to work the night shift. So if you want to have modern trade, if you want to have restaurants, beauty salons, the best way to sweat out the real estate is to keep them open for 12 hours, 14 hours. If you want to do that till 10, 11 p.m., labor laws didn't permit you to allow employ women, and which meant that half the population was ineligible. Now states have opened it up. So I think participation rates, labor input are a major factor. Capital input, a large part of the capital cycle is actually driven by just 2 major drivers of capital, which is real estate, both commercial and residential, and energy generation. Everything else follows from that. So everyone thinks that private sector capital investment is somehow the starting point. See, no one does capital investment as for Samaj Seva or basically for social work, right? So if we are relying on market forces, Businesses will invest when they must. And the starting point of the investment cycle, our research shows, is the real estate cycle and the power generation cycle. And that is where we had seen a dramatic slowdown between 2012 and 2022. In the last 3-4 years, we've seen a significant improvement. So, for example, if the investment to GDP ratio goes from 27% to 33%, the increase from the central government, and if you have combined the state and central governments, maybe 1.5% of that. A large part of the rest has actually come from the fact that the real estate cycle has turned. And in the next 3-4 years, all the announcements on the power generation side are now starting to get into play. So, or will hit the construction stage. So, I think investments are happening because India's number of households is expanding at 2.4% a year. As people become more prosperous, they want bigger houses. The average Indian lives in 130 square feet of constructed space. Average Chinese in a tier 3 town lives in 550 square feet. The average American lives in 700 square feet. People want to get into better quality houses. That is massive demand. You look at a country like Malaysia. See, when we get to 20 trillion, we will be at about $12,000-13,000 per capita. Malaysia today is at $13,000 per capita. 81% of the capital stock is real estate and infrastructure. So that needs to be built. And therefore, I think that the government role in this is completely misunderstood. The government is very wisely maintaining fiscal discipline, improving the quality of its spending so that the cost of capital keeps coming down. And once the cost of capital comes down, many new investments become possible from the private side. I think we are well underway on that path. And all we need from the government and the state governments have been slipping a bit on the quality of expenditure, but not a bit, quite a bit on quality of expenditure. They need to really haul it up. I think the economic survey does an excellent job of telling the state governments that, look, when people look at India, they look at general government deficit, they look at general government debt to GDP, not just the central government. And therefore, it's extraordinarily important that the state governments also follow this kind of discipline. So there are challenges, but I must say that the cycle is well and truly underway. The post-COVID recovery is still weak, meaning that we are about 1 to 1.5 years behind the pre-pandemic path, which means that there is 1 to 1.5 years of new workforce which is without work. See, unlike, say, China or Japan or Europe, where the workforce is shrinking, and so if you are 1 year behind where you were supposed to be if COVID had not happened, you don't really have a labor force problem. You have other issues, but that's not the biggest. The labor is not a bigger issue. In India, there is significant slack in the labor market. And while some people would say that's one reason for actually the fiscal deficit to go up, not down, I think the choice of allowing the private sector to actually shape up and allow monetary easing to drive that growth or fill that gap is, I think, the best advised option. And that seems to be what the policymakers have adopted.
You spoke about labor codes and also the economic survey. The economic survey does have a chapter on employment and skill generation, and they've spoken about the 4 labor codes and how that so positively and significantly impacts the platform and gig workers as well. So I would just like to ask you from a more broader question. Yesterday the economic survey released. What stood out to you exactly most in its diagnosis of the India's economy? Like, was the goal primarily to reinforce confidence in the current growth model, or did it flag structural risks that deserve more attention than they are currently receiving, for instance?
Look, there is a lot to unpack in the economic survey. As you know, it is 736 pages. It's been less than a day since it was released, so I will not pretend to have read it fully. I did get the help of some very capable teammates who kind of summarize the takeaways for various chapters. An additional teammate I have in my team is Gemini 3. That has also been very helpful. But beyond that, I must say that the key takeaways for me from the economic survey are that it allows or it focuses attention on the improvement in the trend growth rate. So I remember the years post-COVID where some very senior economists pretending to know more than they did would claim that India would grow at 4.5% post-COVID because anyway, pre-COVID, we had slowed to 6.5%, and COVID scarring was so deep and the government had mismanaged it so badly that we would slow down to less than 5%. As the growth has continued to surprise on the upside, those numbers have been going up. Most people had gone to the 6.5% trend growth range. And not to sort of pat my own back too much, but I have been in the 7% or higher range. That's our trend growth. And I'm very happy to see that Anant and his team have put out 7% as the trend growth. Now, it is extremely important to understand the role that the economic survey plays, and the economic survey, the role that it plays currently, today, with the current chief economic advisor. Generally, the temptation that the economic survey and the budget are sort of, or the economic survey is in some way a prelude to the budget, I think that assumption is flawed. The two teams work, in my understanding, work very differently and separately, and therefore anticipating that all of this will show up in the budget on the 1st of Feb is a mistake. But at the same time, what we have seen is if the CEA is highly trustworthy, and I think Dr. Anant Nageshwaran is definitely, I think, ticking all the boxes because of his intellectual honesty. I think the depth of his understanding, he gets very high credibility within the government. And what we have now started to see is that the issues that he flags in his economic surveys tend to start becoming priorities for the government. Because while for people outside, I think, the mistake of expecting that, this is what we should get in the budget, or some very interesting analysis that used to get put out by earlier CEAs. In this case, the fact that MSMEs are the biggest beneficiaries of regulatory reform, reduction in compliances, reduction in clauses that have criminal punishment. Well, guess what? That has become reality. He flags it's important that we treat the Chinese with pragmatism, that if instead of getting Chinese goods imported, it is better to get the Chinese to start setting up factories in India. Guess what? It actually shows up in policy a couple of years later. So from on that front, therefore, some of the suggestions made in this economic survey are actually, I think, very interesting. So over and above the 7% growth rate, so what it does is it becomes the anchor for many of the consensus forecasters who, frankly, on trend growth may not have been applying their brains too much, that this is perhaps the trend growth that India will be anchored to. So 7% then becomes a new anchor, which I think is fantastic. We need to aspire for faster growth, but 7% is a good start. The projection for this year's, that is FY27's growth, 6.8 to 7.2, is a bit lower than what we have. We think we can grow at 7.5% in real terms in FY27. But again, this is above consensus, and I think it sets the direction in a very positive way. I think the prioritization for urbanization, if you ask me, that is the biggest risk for India's growth sustaining over the medium term. We have very successfully managed to break this fear we had in the early decades of our independence, that India needed a very strong center, that otherwise it would get fragmented. So thankfully now, state governments driving their own growth, dramatic changes. In fact, the labor codes that you mentioned, of course, the notification was from the center, but actually the state governments are doing much, much more in terms of the reform process and decriminalization, because finally it is they who need to do it. So 80% of the clauses that have criminal punishments are at the state level. So the center can, on some of these cases, only guide. The changes need to happen at the state level. And it's very happy to see that many of the states are actually are doing so. So, but the level 3, so level 1 to level 2, I think seems to be well in play. But what we now need to see is state governments allowing districts to have more authority, having empowered professionals. I don't think our political system is going to change, but at least having more empowered district level administration is extremely important. So if we don't get our urban infrastructure right, if we don't get to that granular level of management, districts in UP are bigger than provinces in Indonesia. And that holds true for most of the states. I think it is important for tier 3 to actually come in play. And that, I think, is extremely important for urban infrastructure and the challenges. So there's a whole big chapter on urban, which I hope influences government thinking and process going forward. Even on the manufacturing side, the very delicate balance between trade openness, frankly, with the EU FTA and the slew of FTAs that India is signing. India is clearly demonstrating to the world that we stand for open trade, that open trade, free trade is actually good for everyone. But at the same time, when you have protectionism rising across economies, and more importantly, it is very clear, to state the obvious, the Chinese are misusing the rules of free trade to dump their own excess capacity on the rest of the world. We need to be pragmatic. With the weaponization of technology, the weaponization of energy, I think all of these issues should increase protectionism, right? So you have, on the one hand, the clear advantage of free trade, of efficiency, of productivity, and on the other, the rising protectionism in the world. So I think this chapter on how to find the balance between the two is a very important one. And I think the government is so far going about it in the right way. Some of the things you wish could be done faster, but for example, the removal of quality control orders or the rescinding of quality control orders on intermediate goods is fantastic. I think it just helps our MSMEs and exporters become more competitive. So I think some of these chapters bring up very important discussion points. It does not mean that those will get addressed in the next month, but I think the chances of them getting addressed in the next 1 or 2 years then, of course, increase because they showed up in the economic survey.
Interesting. You spoke about open trade and free trade. So I'm a bit tempted to ask you a question around the India-EU free trade agreement now that it's been finalized. Now, what does it meaningfully change for India's economy beyond the headline announcement? You know, we've had the announcement everywhere. We know it's a great start. So should it be seen primarily as an export opportunity, a supply chain signal to global investors, or should it be seen as a broader credibility marker for India's trade strategy?
I think it is both. So the fact that now 50% of our goods exports are under free trade agreements is a very strong signal that we stand for trade openness. I think the geopolitical signaling, remember that with about 400 million people, in India with about 1.45 billion people, we are a very large part of the global population. And if we are deciding to join hands, I think it's a very important signal. It's not just a trade and economic signal, but it's also a geopolitical signal. And I would see the trade agreement as a starting point because it's mostly about goods trade. There are a few nods to services trade, but I think the movement of people, the movement of capital. So while the desire was to have a comprehensive free trade agreement, this one seems to be more of a starting point. the carbon border adjustment mechanism, I think the challenges that some of the exporters to Europe will face have not been addressed. But clearly, when you get into a negotiation, both sides cannot get what they want. A sign of a good negotiation is both sides come away a bit disappointed. That's the sign of a good trade deal. So, in this case, I think we've covered a lot of ground. The immediate economic impact may be very limited because the first thing is this needs to be ratified by all the European countries. You must have seen what happened to the Mercosur deal. It's now suspended for 2 years. So with Europe, you can never be sure how long it takes to finally get it going. But one hopes, given that some of the more contentious issues, so that's the compromise, right? So you either aim for something very strong, in which case there could be strong resistance, or you go for the incremental approach. You get the things that can be easily done, and then they become easily acceptable as well. So the chances of this going through are much better because there's no agriculture on both sides. There are sensitivities, but it'll take a year or so for it to become fully effective. But on the labor-intensive exports from India, I think the impact can be quite positive. So what we are already seeing in the newspapers is that European buyers, and remember that for apparel, Europe is a much bigger market than even the US. So the major European buyers are actually now starting to get very active. India has also done the preparatory work. So the removal of QCOs on the viscose staple fiber, PTA, these are the starting points for man-made fiber, which then, if you don't have that, if you're not competitive on that, you can't have man-made textiles. And if you don't have man-made textiles, you don't have man-made apparel. And so that was the reason that was a major reason why India was not doing well on apparel. I think by rescinding those QCOs and then signing this FTA with substantial reduction in duties, which now India becomes very comparable and competitive with Vietnam and Bangladesh, is phenomenal for sectors like those. So there are a few sectors which I think benefit meaningfully. In terms of supply chain integration, the access to technology, the Europeans, wine and cheese we can set aside, maybe cured ham, but because finally those are very small markets. I think the fact that cars can be imported maybe is the right, because now that the Indian car industry is of a certain scale, and in order to make them more competitive on the upper end of the cars, which will then make them export ready and start competing with the Chinese. I mean, the Chinese high-end cars are now absolutely astounding. That level of competition at the higher end should make our industry more agile. And again, it seems to be a fairly well thought through deal, and I'm quite optimistic. But again, I would see this as a starting point of much deeper engagement.
Interesting. We are very close to the union budget 2026-27. So this year's budget, given the economic profile, is being presented without the pressure of an immediate macroeconomic crisis. Growth is strong, inflation is manageable, fiscal credibility is intact. So in such moments, what, according to you, should a finance minister prioritize? Is this the right time to tackle long-standing distortions rather than, announce incremental spending measures?
Look, the government has very successfully transitioned, or maybe the full transition may not have happened, but actually is transitioning, and it has been very successful so far, towards increasing the predictability of India's fiscal balance. So in FY21, at the end of FY21, you can imagine how hard it would have been, and all credit to the bureaucrats and the political leadership at that time to commit to less than 4.5% deficit in FY26. Imagine level of uncertainty we were all facing in February 21, and they committed to it and delivered on it. Then once that got over, now they've delivered another medium-term target of 50% debt to GDP. So by FY31. So I think we have to stay on that path. That's the most important challenge. And once you set those targets, the cost of capital starts to fall. So I think the Indian bond market is still not attuned to it. I mean, there are still too many people counting the pennies. And in the near term, of course, despite all the fiscal discipline signs, the yields have actually gone up from 6.5 to 6.7. I'm expecting that they will fall substantially over the next 12 months because of the demand supply changes that are happening and the fact that the government is absolutely focused on its fiscal target. So once you put yourself up to a task of bringing down central government debt to GDP to 50% in FY31, the rest of it, leaves very little room for maneuver, in the sense that if your nominal GDP growth is, say, 10.5%, and while I think that tax to GDP should be rising in FY27, and I'm happy to answer that if there are detailed questions on that, but on why. But the government, given that tends to be very conservative, it may assume a flat tax to GDP, because that's the most credible way of forecasting, or most defensible way of forecasting, and therefore there's a certain amount of revenue that you are left with. And given that the pay commission is due in FY28, so the pay commission is now underway. The counter has started 1st of January this year, but the pay commission recommendations may only be effective next fiscal year. So given that there could be a 1% of GDP increase in salaries and pensions for the general government, on top of which you have to also pay arrears. So because the counter started this year itself, next budget, you may not be able to consolidate as much. And therefore, you may need to do a bit more than what you would have needed to otherwise. In which case, where is the room to spend? So once you have your interest costs, salaries and pensions, essential subsidies, politically essential subsidies, and some amount of defense expenditure, all the 50 lakh crores get accounted for. So it's very difficult for the budget to have some massive fiscal announcement. And if you see the pattern the last 3-4 years, the government has stayed away from these kind of announcements which may be politically convenient, but actually don't have that much economic and fiscal impact. But there is a second part of the budget, which is the budget speech. So there is the fiscal math, and then there is the budget speech. Given that the high-level committee chaired by Mr. Rajiv Gauba has been sending out recommendations on a regular basis for reform, it is quite possible that some of the reforms they have recommended, especially when it comes to sectors like finance and economics, or say taxation, could actually be implemented. I think this is the right time, especially when your macroeconomic conditions are stable, that you can afford to take some policy risk. See, when things are in churn, you don't want to disrupt too much because you're too scared. It's like, if your car is already creaking, you don't want to be really going through a bumpy road. But if your car is healthy and you want to get from point A to point B faster, it is possible to drive a bit faster, assuming that even if there are bumps, the car can withstand it. And this is what this is more an aspiration than an expectation. Meaning, I'm happy if it happens that we see some meaningful reforms which ease the doing of business and improve our longer-term prospects. In terms of challenges, I think the biggest challenge remains the credibility of our taxation system. The world outside, remember that the beauty parade for global capital is only getting tougher, as we discussed early in our conversation. With all this global uncertainty, it is quite possible that global capital flows dry up even further, in which case you need to be really attractive. And for that to happen, I think we really need to improve the predictability of our taxes and the simplification of our taxes, and make our tax authorities a lot more trustworthy. The fear that many of the foreign investors seem to have, both direct and portfolio investors, is something that we need to actively address. Much of that fear may be unjustified, but still there exists a lot of fear, and that needs to be addressed. So I think there is a long distance to cover. I'm hoping some of it does get addressed in this budget.
Interesting. So yesterday in the economic survey, of course, it was highlighted that the merchandise and services have been doing very well. But I would like to narrow down to a sector that we should talk a little more regarding, which is the agriculture, inflation, and the political economy bit. So agriculture remains a persistent source of income volatility and episodic inflation pressure. Despite decades of policy debate, meaningful reform has proved to be politically difficult. Now, from a macroeconomic standpoint, what do you think? Why has this challenge been so intractable? And can India realistically sustain high growth without addressing it more decisively?
Look, again, I disagree with the framing of the question. So we'll get to what needs to happen. So I'll break it down to three parts. I think the first is how does agriculture affect incomes and the broader economy? The second would be what have been the challenges in addressing them, and the third on how does this get shaped going forward. So let's start with the impact on the labor market and the broader economy. Look, as you must have seen in some of the new CPI, I mean, we'll see the new series in late February, but it seems that the weight of food will come down substantially, and the weight of raw food will actually fall even more. So overall food may be 35-36%, looks like, from what the newspapers say. But processed food may actually go up, raw food. And that's consistent with how our food habits are changing, not just yours and mine, but also, I think, for the broader economy. I expect that processed food will become even more important going forward, given what has happened to GST. That the formalization of food processing will accelerate, is starting to accelerate, and I think will get mostly done by the next 3 to 5 years. Within the labor market, so on the consumption side, the share of food, it is natural as you become more prosperous, share of food starts to fall, and this is a process which is well underway. The second part is what really is or how is the nature of food itself changing. So as the survey also talks about, and for those of us who track agriculture in detail, we've known for a while that the growth in livestock, the growth in fisheries, the growth in fruits and vegetables is much faster than the growth in the rice, wheat that everyone keeps talking about. So the gross value of output of the politically sensitive parts of agriculture is actually, the share of that is actually shrinking. Especially if you think about, rice output going from 100 million tons to 150 million tons in a population where per capita rice consumption is falling, which is what the household consumption expenditure survey says. As people become more prosperous, their calorie consumption shifts away from just pure grains. These are signs that the value is not much value in having a lot more of rice and wheat incrementally for the economy by itself. But on the labor market side, if there are 22-23 crore people who call themselves or who say that their primary income source is agriculture, remember that the number of people claiming benefits under PM Kisan is only about 9.7 crore. So there are 12-13 crore people who are landless workers. So their wages are not really determined by what's happening to food prices. So it is more demand supply for labor in aggregate. Even in those 9.7 crore farmers, there are only 3 or 4 crore farmers who have marketable surpluses. So in India, the average land parcel is too small. Most of the people are subsistence farmers. They may have 1 or 2 acres. They'll grow enough rice to sort of feed themselves for 6 months. They may actually have to buy rice or wheat or whatever from the market for the rest of the year. In the 2018-19 agricultural census, it was also clear that I think 56% of incomes for agricultural households was non-agricultural, meaning that a lot of the employment is part-time, and therefore there is significant. So the market is already shifting away in the sense that the non-agricultural sources of income are going up. The unregulated livestock, fisheries, fruits and vegetables are actually, well, fruits and vegetables are less regulated, but their share is going up. And therefore the political challenge is kind of being addressed by the market a bit too slowly. That doesn't mean that we shouldn't try to target it. Then the second part of the question is why is it so hard to do? It is very hard to do in every single economy. You can see how important, despite the fact that I think there are some 4 million people in the US who do farming, you see the political power that they have. You look at the power of the farmers in Europe, and some of this could be just the politicians playing it safe, but it is a vexed issue. When we expect our politicians to go out and solve these problems, be it at a state level or the central level, for example, states are allowed to tax income from agriculture. Which Indian state has even tried thinking of it? So these are politically very tricky things, even though if you put the threshold high, the number of people affected would be so small that you may not lose any votes, but it is too dangerous to even venture down that path. And so everyone plays it safe. So it is unwise to then expect for some politician to go and sacrifice themselves on the altar of fiscal discipline and start taxing high-income farmers. And therefore, this is unlikely to happen. So as much as you and I may prescribe, this is very important, or that, try reducing fertilizer subsidy, or the fact that food subsidy, when the National Food Security Act was passed, India's poverty ratios were 25-26%, and the NFSA decided that let's do 3x of that and give 75% of the people subsidized food. Today, the poverty levels have dropped to 1/4 of that. So shouldn't the number of people getting free food grains be cut down to, say, 25%, not 75%, which will save significant amount of fiscal resources. But I think this becomes effectively a no-go because politically this will be too damaging. And therefore, as much as we would like to, I think the expectations on some of these changes should be very low. Third, how do things change going forward? I think the market level changes are happening. I think they are too slow. I'm not saying that that's the right way to solve this problem. The other day I was reading in one of the papers that there is this farmer who has aggregated some 5,000 acres to do carrots. There are these farm aggregators, and then getting into large scale potato farming and onion farming and so on. And these will help solve many of our price volatility challenges. So vegetable inflation and volatility in vegetable prices has been a big factor in macroeconomic policy making. This is something that I wish does get addressed by policy. But from the labor market perspective, the income perspective, I think a lot of important changes have started to happen in the markets are reasonably free.
Very interesting. We have approached towards the end of the interview and the conversation. Mr. Mishra, thank you so much for joining us and for sharing such thoughtful insights with The Print. A big thank you to all the viewers for watching, and we will see you soon with more such conversations on India's economy and public policy. Thank you once again, sir.
Thank you for having me.